Okay, so MongoDB just landed the biggest single contract in their entire history. They finally flipped to real GAAP profitability, and the market responded by just vaporizing a quarter of their valuation in like 20 minutes. You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. Today is March 2nd, 2026, and we are looking at MongoDB, ticker MDB, and their fourth quarter results. Miro, please make this make sense to me.
Look, the print itself is objectively solid. You have total revenue hitting $695.1 million. That is up 11% quarter over quarter. Gross profit is expanding, and they hit an operating margin of 23%. They are actually bragging about hitting the rule of 40 this quarter. Oh, and GAAP net income came in at $15.5 million, which is 18 cents a share.
Quick housekeeping, just to sanity check things for everyone listening. This is strictly not financial advice, just our own personal market opinions. But back to those numbers, they sound incredibly clean. So why the violent sell-off? I mean, the stock closed the regular session pretty quietly around 325 and then just dropped straight into the 240 range almost instantly after hours.
Yeah, it is all about what is hiding inside that revenue jump. They signed an absolute elephant, a multi-year $100 million total contract value deal for their Enterprise Advanced Suite. That is their heavy on-premise legacy database software. Some massive financial institution just backed up the truck.
Wait, can I jump in? $100 million on-premise? I thought everyone was forcing their data into the public cloud right now.
You would think, right? But heavily regulated banks still need that local operational resilience. The problem is that one giant deal severely distorted the optics for Atlas. Atlas is their fully managed cloud service, kind of the engine of their future valuation. It brought in $502.6 million, but the growth rate looked weirdly soft because the billing on that mega deal got forced into the legacy bucket.
Oh, so it just sucked all the oxygen out of their actual cloud growth story.
Exactly. And it gets worse. On the exact same day they print this historic profitability, they unceremoniously dump their top two revenue executives. The chief revenue officer and the president of field operations are both stepping down simultaneously.
You do not fire the guys who just closed a $100 million contract unless the pipeline behind it is looking pretty grim.
That is exactly what the market is pricing in. A structural breakdown in the go-to-market strategy.
And I'm guessing the AI narrative didn't save them either, because they provide the database memory for huge AI startups like 11 Labs. So you would think they're swimming in generative AI demand right now.
Well, they are. Actually, the CEO was incredibly blunt about this on the call. He admitted that true enterprise-level agentic AI just isn't moving the needle yet. It's all still internal testing at these big companies. No massive database scaling from AI workloads today.
Wow, that is so refreshing to hear from a CEO, but also terrifying for investors who bought the hype. All right, let's get into the details and unpack exactly what this leadership shakeup means for their core business going forward.
To understand the shakeup, you really have to look at what the CEO was hinting at on the call. He was asked directly about losing those guys, and he basically said, look, we want disruption to be minimum, and he has confidence in the regional leaders taking over, but the reality is much deeper than just shuffling managers around.
Right, because you do not casually drop your top sales guys just to, minimize disruption. There has to be a structural reason.
Exactly. I was going to say, actually, this is a total architecture pivot. The CEO is pulling out his old playbook from when he was at ServiceNow. He explicitly talked about leaning much harder into systems integrators and the hyperscaler clouds. So your Amazon Web Services, your Microsoft Azure. The old direct sales enterprise model is it is too slow for where they want to go.
Okay, that actually makes sense. It's like they're realizing they can't hand carry every single deal if they want to catch the actual AI wave when it finally hits the enterprise. They have to let the big consultants sell it for them.
Yep, they need to be embedded in the plumbing. And speaking of plumbing, we need to talk about the absolute best thing in this entire report, because I am telling you, it is beautiful.
Oh boy, you found a beautiful spreadsheet cell? Please share.
I did. I really did. Look, The biggest sin in hypergrowth tech is stock-based compensation, SBC. Companies print all this revenue, they say they're profitable, but they're just bleeding out the shareholders by paying their engineers in newly printed stock. MongoDB had $144 million in SBC just this quarter alone.
Yeah, which is basically pretend money until it hits the open market and crushes your stock price. It's the number one pet peeve for tech investors.
Precisely, but here's the pivot. They generated over $176 million in operating cash this quarter. Their capex was basically zero, literally $1.1 million. So they're throwing off this massive pile of free cash flow.
Hold on, just a sanity check. What are they actually doing with that cash? Because usually these guys go and buy some random AI startup at a massive premium.
That is the genius part. They're not buying anything. The CFO straight up said on the call, and I will quote this exactly, "In fiscal 2027, we currently plan to commit 100% of our free cash flow to these two actions. Those two actions being share repurchases and cash settling the tax bills on unvested equity."
Wow, 100% of it. So they're just plugging the dilution hole entirely.
Oh, sorry. Yes, entirely. They are neutralizing their own SBC bloat. It is basically a control system feedback loop applied to a balance sheet. They're taking their incredibly high gross margins and turning them into a dilution shield. Honestly, it is one of the most disciplined capital allocations I have seen in software all year.
So they are actually acting like a grown-up company instead of chasing vanity growth at all costs. They're saying we are going to defend the equity value we already created. That is huge for long-term holders if they stick to it.
They kind of have to stick to it because their hyper-growth phase is mostly behind them now. They expect the legacy Enterprise Advanced revenue to normalize down to low to mid-single-digit growth next year. Everything is reverting back to how fast they can scale Atlas consumption. They are purely in the efficiency and execution phase now.
Okay, so pulling this together, we have a massive on-prem elephant deal kind of masking some slowing cloud momentum. We have a totally gutted and rebooted go-to-market leadership team, and this giant pivot to cap shareholder dilution using every spare dollar of cash flow.
That is a pretty good summary. It is an incredibly aggressive transition period wrapped in a decent earnings print.
So where does this actually leave them heading into the next quarter and the rest of the year? Because clearly the market thinks they might stumble.
I think it leaves them staring at a massive transition year, and the market completely hates transition. Look at their Q1 guidance. They are projecting roughly 20% growth, putting revenue somewhere between $659 and $664 million.
Okay, 20% really doesn't sound like a stumble to me.
It is. Sorry, it is when you look at the full year. They're modeling 2.86 to 2.9 billion for fiscal 27. That implies a normalization down to low double-digit growth. Though the CFO did point out they are providing an outlook with more upsides than downsides, specifically related to the legacy EA business.
Right. So they are setting a very comfortable low bar while the new sales leaders are figuring out where the bathrooms are.
Exactly.
Wait. Can I jump in? Because if the core growth is slowing down to low double digits, aren't investors just sitting around waiting for AI to bail them out? We keep hearing about these autonomous AI agents that require massive database scale.
Yeah, but the CEO was practically waving a yellow caution flag on that exact premise today. He told analysts, yes, they have done a few productivity types internally, but nothing at scale that is customer-facing.
Which is just the ultimate tech cycle reality check. Everyone is modeling the AI revolution for tomorrow morning, but actual enterprise plumbing takes years to replace.
Precisely. The revolution is currently stuck in corporate testing environments. And that is why the stock got punished today. The market wants AI euphoria. MongoDB is offering strict capital discipline and a rebuilding year. It is a brilliant corporate move. It's just terrible theater.
Quick sanity check then. So the real takeaway is that MongoDB is finally acting like a mature adult and Wall Street is throwing a tantrum because it's not shiny enough.
That is basically the entire history of public markets in one sentence.
I love it. The severe financial penalty for being responsible. Honestly, that is the perfect place to leave it for today.
All right, my brain is officially full for today, so if you want these earnings drops to just show up for you, definitely hit follow on the podcast. And just as a quick, transparent aside, this show is put together with AI helping us instantly read through those hundreds of pages of dense financial filings. Oh, and if you have a ticker you want us to cover, drop a note to earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for hanging out, and we will catch you later.
See you next time.